At the end of the year, we close some of our accounts, not all of them, just some of them. That means we reset their balances to zero. Let's take a look at the accounting equation. Let's notice that assets, liabilities, and equity are balance sheet accounts. The revenues and expenses, those are income statement accounts, and the dividends account is found in the statement of owner's equity. The balance sheet accounts are called permanent accounts. Some textbooks use the Old English and call them real accounts. These account balances do not reset to zero. The revenues and expenses and the dividends, those are called temporary accounts, and those are reset to zero. And the way that we do that is we transfer all of the balances of the temporary accounts to retained earnings. There are two ways of doing this. Some textbooks use the 2-entry method, and other textbooks use the 4-entry method. First, I want to explain the better method, in my opinion, the 2-entry method. Now, don't panic. This slide is the end product that I'm going to walk you through. Okay, I've erased some numbers. You'll see here some numbers in black and some numbers in blue. First, let's talk about the black numbers. Those numbers have nothing to do with closing entries. They're often put in a homework assignment as a distraction. It's a tactic of accounting homework to give you information that you're supposed to ignore. Well, just ignore those black numbers. See those blue numbers? Those are the balances at the end of the year in these 5 accounts. I'm going to walk you through a really super simple business that only has 5 accounts, and we're going to close these balances. That means we're going to transfer these blue numbers to retained earnings with 2 journal entries. The first closing entry takes the sales or the revenues and the expenses, all that in that highlighted red oval. All those numbers are going to be transferred to the credit side of retained earnings if they add up to a profit. Occasionally, however, the expenses will be larger than the revenues, and in those occasional years, we will close the net of the revenues and expenses to the debit side of retained earnings. The second closing entry is to simply move the dividends balance over to the debit side of retained earnings. Okay, I've cleaned up the slide again. All right, this looks busy. Let's start with the sales account. It has the blue balance, a credit balance of $10,000. How would you close a credit balance of $10,000? You have to insert a debit. So we've inserted the red debit to the debit side of the sales account, and that makes that account 0. Now look in the journal, we've also debited the sales account because every number that exists in the ledger must also exist in the journal. Now let's look down the column of expenses. The blue numbers were the balances that we want to close. Rent expense has a debit balance, so we have to insert a credit to the rent expense account to close that account. We put a credit of $3,000 to the rent expense in the ledger, and then look at the journal. We also credit rent expense for $3,000. Every number in the journal must also exist in the ledger. Let's look at wages expense. It has a debit balance of $2,000, so we insert a credit of $2,000 to close that account. And look at the journal. We also credit wages expense for $2,000. There's one more expense to close, cost of goods sold. It has a debit balance of $1,000, so we will insert a credit that red credit to the cost of goods sold account to close that account. And look at the journal entry. We credit cost of goods sold there as well. At this point, our first closing entry doesn't balance. We would have 10,000 on the debit side, and on the credit side, we would have 3,000, 2,000, 1,000. That would total 6,000. We need to plug $4,000 as the last number on the credit side in the first closing entry, and we will credit retained earnings. That's how we get the net of those revenues and expenses, the net, which is equal to net income. But that number is credited to the retained earnings account. The second closing entry is easier. It's shorter. Let's look at the dividends T account. It has a debit balance. The blue number is the balance at the end of the year that we want to close. So how would you close an account with a debit balance? You have to insert a credit to the dividends account to close it. So we'll credit the T account for $500, and we will look at the journal, also credit dividends in the journal, because every number in the ledger has to have a corresponding number in the journal. And we will debit retained earnings. There you go. 2 closing entries, and all of the temporary accounts are now closed or reset to 0. Next, I'm going to teach you the other way of closing the accounts. This is the 4 closing entry method. I'm not a fan of this method. I never have been, and it's a mystery to me why the textbooks have been teaching it for so many years, but they're starting to wake up and abandon this style, and they're just using the 2-step method. So in this method, what makes it so difficult is we close in 4 journal entries. The first closing entry, we move the revenue accounts to an account called income summary. It's like a scratch piece of paper. We just move the revenues to income summary. And then number 2, we move the expenses over to income summary. And then we calculate the net or the balance of revenues and expenses in income summary, and we transfer whatever balance exists in income summary after the first 2 closing entries here, and we transfer that income summary balance to retained earnings. That's step 3. So the income summary account only exists for a minute or a few minutes as we do this. Step 4 is the same as in the previous method. You just close dividends to retained earnings. Okay, so let me walk you through it. Here we are back to the beginning, cleaned it up, and I've deleted the T account for common stock. That was a distraction anyway. I don't have room for it now. I made my journal bigger because I'm going to have 4 journal entries. And look on the right here, I've added an account called income summary. Don't ask me if it's an asset, liability, equity, revenue, expense account. It's none of the above. It's just an account that's going to exist for a moment. First closing entry, move the sales over to income summary. So how would you close sales? Sales has a credit balance, so we will insert a debit to the sales account to close the sales account. And if we debit sales, we will credit income summary. The next thing we're going to do is we're going to transfer all the expense accounts to income summary. We're going to close all of the expense accounts. We're going to have to credit each of those expense accounts and debit income summary. So here we have inserted these red credits to all the expense accounts. They add up to $6,000 on the credit side. So we must debit income summary for $6,000. In the first closing entry, we put a credit to income summary, and in the second closing entry, we put a debit there. The credit represents the revenue that was transferred to income summary, and the $6,000 represents the sum of all the expenses that was transferred to income summary. And the net amount of $4,000 is a credit balance in income summary, which happens to be equal to net income. The third closing entry is to move that $4,000 out of income summary and move it over to retained earnings. Again, we want to move that $4,000 to retained earnings. In this case, the $4,000 in income summary is a credit number. That means that year we had a net income. But sometimes income summary could have a debit balance in the years when we had a net loss. If we had a net loss or a debit balance in income summary at this point, you would transfer that debit number over to the debit side of retained earnings. So here's what the journal entry looks like. Debit income summary, $4,000. Credit retained earnings, $4,000. So these three closing entries right here are equivalent to one closing entry in the two-step method. Why did we use this income summary stuff? What did that do for us? Not much. Just adds confusion unnecessarily. Lastly, we'll move the dividends over to retained earnings, just like we did in the two-step method. It's the same thing. Dividends has a debit balance that we're going to move to the debit side of retained earnings. So we will credit dividends for $500, and we will debit retained earnings for $500. That's exactly what we did in the two-step method. So to review, the balance sheet accounts are permanent accounts. They are not reset to zero, but the income statement accounts and the dividends account are temporary accounts. They are reset to zero. That means their balances are transferred to retained earnings. There's two methods of doing this, the two-step method or the four-step method. The four-step method uses that abominable income summary T account.